I would say net, I'm optimistic about return prospects in the U.S. equity market in 2025, but I do want to provide a bit of balance here in this conversation, because on one hand, we have, I would say, earnings growth expectations for 2025 that are fairly robust, anywhere between 10 and 15%, depending on which analyst from the sell side you ask. But the only thing that I would say, and it's not necessarily an issue in and of itself, but what we see is that the composition of the S&P 500 from an earnings perspective, it continues to be more and more information technology related from a sector perspective.
Yeah.
So again, I don't think this is an issue. The tech sector has driven earnings over the last 3 years. It likely will be a major factor next year as well. And like I said at the onset, in and of itself, this is not an issue, but this idea of earnings concentration does bear some consideration, because when you get cyclicality in certain parts of the market from an earnings perspective, if that part of the market, like tech, is an increasingly large component of market indexes, that's just going to have a bigger swing factor, if you will.
Yeah, and I think almost like any other healthy market, whether it's price or earnings, you want the participation of price or the participation of earnings to be broad. You don't want it to be so concentrated just in one segment or sector.
Right, and what I'm showing on the screen right now is showing you a snapshot of S&P 500 index earnings per share broken out by sector. The bottom part of this area chart in blue is the information technology sector. And I guess to your point, it's not like tech is approaching 50% in terms of contribution to the S&P's overall earnings. It's at 25-ish% right now. It's grown from 20% in the late 2010s. So it's not like it's this overly concerning level of concentration. And there are other parts of the market that are expanding their share from an earnings perspective, or at least they're expected to in 2025. But it just is something that bears watching for me.
We've talked about this before, but I would also say that the economy has evolved. And we're not the manufacturing economy that we were from the 70s or the 80s. And so as this evolution continues to unfold, you would expect to see more participation in areas like technology as technology continues to advance.
Right. And, I guess just to hammer this home and not be overly pessimistic, but, yes, you have an increasing share of earnings in the S&P 500 stemming from the information technology sector, but that doesn't necessarily mean that you're getting a poor earnings picture, at least from an expectations perspective in 2025. It's actually quite the opposite. We're familiar with the Magnificent Seven, those 7 companies that drove the vast majority of returns in 2023 and also contributed a significant amount in 2024. The earnings picture for those 7 companies has been very good. Growth on a year-over-year basis has been incredibly strong over the last 2 years. That level of growth can't persist forever. I think that's just only natural. So what you see from an earnings perspective, at least on an estimated basis going into 2025, is that year-over-year earnings growth is going to start to taper off for the Magnificent Seven. At the same time, you're seeing those other companies in the S&P 500, so the S&P 500 excluding the Magnificent Seven, start to catch up. And the expectations for earnings from those S&P companies X the Mag 7 is what I'm showing on the chart here on the screen right now. You've got the Magnificent Seven year-over-year earnings per share growth shown in the brown bars. And then all the other companies in the S&P are shown in these green bars. And so what the picture is telling you, again, on an estimated basis, as the Magnificent Seven starts to taper off from this aggressive growth picture that you've seen, other companies start to carry the torch and catch up from an earnings perspective. So even though we're getting some level of earnings concentration that has continued to build up in the tech sector, it's not like you have some tragic picture everywhere else. So I do think that it's net fairly balanced, and all in, I think there's still plenty of opportunities. And given the economic backdrop we discussed at the beginning of this, I have no reason to expect any sort of cataclysmic event.
Outstanding. All right, let's shift to bonds now. The Federal Reserve early in the year in 2024 had high expectations, or at least the market was pricing in a heavy dose of rate cuts. The Fed over the course of the year has revised their outlook on what interest rates or the trajectory of interest rates could look like in 2025. What does that mean for the bond market?
Yeah, well, what I would say is the bond market has gotten ahead of its skis on a number of occasions, even just looking at the last year and a half, 2 years. Where we're at right now, I actually think is a fairly attractive spot for bonds. And I know I've been saying this for the better part of the last 2 years, but one thing that I like to think about is, number one, the fact that you are getting less rate cuts from an expectations perspective in 2025. It doesn't inherently mean anything overly negative for the bond market. Yes, if you have less rate cuts, that would imply less potential for price appreciation in bonds. But I think we talked about this in the second quarter or quarterly edge, or maybe it was the third, at any rate, some point in the last 6 months. I showed a chart that showed that the vast majority of total return in the bond market is dictated by your starting yield. And so if starting yields are higher, which is basically what we're saying when we say the Federal Reserve is going to be exhibiting less rate cuts in 2025, I mean, that should imply an attractive entry point for bond investors. Sure. The other way to think about it is that when you look at, to me, I always try to think about things in relativity. So it's not like we're just making an absolute call on stocks, an absolute call on bonds. When you look at the bond market, you can look at a number of different measures that can display relative attractiveness versus something like a different asset class like stocks. One thing is the equity risk premium. We've talked about what that is in the past. Another way to look at this is just a yield comparison. So you can't necessarily look at, the dividend yield versus the coupon rate of the bond market. But what you can do is try to find some apples to apples comparison. So when you look at bonds, you're trying to find something like a yield to worst, right? Your worst possible yield if your bonds are called away. As that rises, like I said, higher yields are going to dictate a higher total return, at least back through history. When you look at the stock market, you can look at something called the earnings yield. It's just an inverse of the price to earnings ratio. So the earnings yield is earnings per share divided by stock or index price. When that's really high, you could kind of think of that as undervalued because you have a really high degree of earnings power relative to share prices. When it's really low, you could kind of view the market as somewhat overvalued. So what I am showing on this chart is the yield to worst of the Bloomberg US Aggregate Bond Index, basically just a collection of investment grade domestic bonds, versus the earnings yield of the S&P 500 index. Again, like this is the earnings per share of this index divided by the price. It's the earnings power divided by the price. So it's trying to show you some level of valuation.